Hey, welcome back to the deep dive. You know how it is 1 minute you're trying to understand the latest AI breakthrough, the next the stock market's doing a roller coaster, and then suddenly there's talk of trade wars. It can feel like you need a decoder ring just to keep up with the tech world.
Hey, yeah.
Well, that's what we're here for. You handed us a seriously packed dossier this time. Everything from leadership shifts at Meta to the wild ride of Tesla and even some rumblings of how chips and tariffs might be connected. Ready to make sense of it all.
Absolutely. It's a fascinating, interconnected web of developments. What really jumps out is how different sectors, AI, finance, manufacturing, even geopolitics, are all influencing each other right now in some pretty significant ways.
Okay, so let's kick things off with a big name, Meta. Their head of AI research is leaving after 8 years. That feels like a major moment, right? Especially since AI is practically the air everyone in tech is breathing right now.
It is a significant shift. 8 years in a field moving this quickly is, well, it's a long time. And the timing, like you said, is key. Meta is pouring resources into AI. It's a strategic priority as they compete with everyone from Google to, these nimble startups. Losing their research lead at this juncture definitely raises some eyebrows. You have to wonder what kind of leader they'd be looking for next. Someone to double down on current paths, or maybe someone to steer them in a new direction.
Exactly. And the reports say they don't have a replacement locked in yet. That sounds like a tough spot to be in, given how competitive the AI talent pool must be. It's not like you can just post an ad on LinkedIn, right?
Right.
Find someone who can head up AI research for Meta.
Not at that level, no. The expertise required is incredibly specialized. The fact that she's staying on until May to help with the transition is a smart move. It buys them some time and ensures some continuity. But the tech world will definitely be watching closely to see who they tap as her successor. It could signal a lot about Meta's future AI ambitions.
All right, let's pivot to the financial side of things. The NASDAQ apparently had its worst quarter in almost 3 years, and it sounds like some of the big tech names that have been driving so much growth, the Magnificent Seven, NVIDIA, Broadcom, Microsoft, Amazon, Meta, they all took a tumble, some down close to 20%. What's the big picture here? Just a bit of a market correction after a long run-up.
It's, I think, more than just a minor dip. What we're seeing is a reaction to broader economic uncertainties. Think about it. Rising interest rates make borrowing more expensive, inflation puts pressure on consumer spending, and geopolitical tensions create instability. These factors can all lead investors to become more risk-averse, and those Magnificent Seven stocks, many of which had really high valuations based on future growth expectations, become vulnerable to reassessment in this kind of environment. It's like the market is saying, okay, maybe that projected growth needs to be looked at a little more critically now.
That makes sense. It's interesting because you hear about some companies still pushing hard on AI. Like Alibaba's co-founder reportedly wants to really ramp up their AI services. Then you hear whispers about Microsoft, despite building all those data centers, maybe slowing down some new AI projects. It feels like there are different strategies emerging.
Exactly. The AI landscape is still very much in flux. Some companies might see the current market conditions as an opportunity to double down and gain an edge, while others might be taking a more measured approach, perhaps focusing on consolidating their gains or reevaluating their priorities.
Right.
Microsoft's continued investment in data centers, though, does signal a long-term belief in the fundamental infrastructure needed for AI, even if they're adjusting their short-term project focus.
And then you've got the whole IPO market feeling a bit sluggish, except for Newsmax. That one feels like it's playing by a different set of rules.
It does highlight how specific market niches and current events can drive individual stock performance, even when the broader market sentiment is more cautious. The surge in a company like Newsmax likely has its own unique dynamics at play and isn't necessarily indicative of a widespread reopening of the IPO window for tech companies, especially those with potentially lofty valuations.
Now let's talk about serious funding. OpenAI. And that reported $40 billion rounds. Sam Altman called it insatiable demand. That's a number that's hard to even wrap your head around.
It truly is a staggering amount of capital. It underscores the immense investor confidence in OpenAI's potential and the continued excitement around generative AI.
What?
When Altman talks about insatiable demand, he's likely referring to the huge appetite for their existing models like ChatGPT, as well as the anticipation for their future innovations and the infrastructure required to support them.
Right.
This kind of funding will allow them to really accelerate their research and development efforts.
Okay, switching gears to something a bit more tangible. The U.S. CHIPS Act. It sounds like the government might be playing a bit of a strategic game with those grants, almost using them as leverage to get semiconductor companies to invest even more in U.S. manufacturing, like saying, we'll give you this, but we'd really like to see you do even more.
That's a good way to put it. The aim of the CHIPS Act isn't just to hand out money. It's to incentivize a significant reshoring of semiconductor manufacturing to the U.S. By strategically releasing the grant funding, the administration, maybe Howard Lutnick is involved here, can encourage companies like TSMC, Samsung, Intel, and Micron to increase their investment commitments beyond the initial amounts.
Without necessarily increasing the total amount of federal grants.
Exactly. We saw this with TSMC reportedly boosting their planned investment after the initial grant discussions.
So it's like a negotiation. We'll help you out, but in return, we want to see a bigger commitment to building up domestic chip production.
Precisely. And it's not just about the grants themselves. The tax credits associated with the CHIPS Act, potentially a 25% credit, are also a major draw for these companies when they're deciding where to invest billions of dollars. There's even been talk of those credits potentially increasing in the future, which would be an even bigger incentive.
It's interesting to think back to the Trump administration's perspective on this, too, with the idea that tariffs on imported chips were already pushing companies to consider U.S. manufacturing.
Tariffs can certainly alter the economic calculus of manufacturing locations by increasing the cost of imported goods. The uncertainty surrounding future tariff policies on semiconductors and related equipment, however, does create a challenge for long-term planning in the industry. Companies need a stable outlook to make these massive investment decisions that can take years to come to fruition.
And while we're on the topic of chips, there was mention of global foundries possibly merging with United Microelectronics, but for older generation semiconductors. That sounds like it could hit some regulatory roadblocks.
Oh yeah. A merger of that scale in a strategically important sector like semiconductor manufacturing would almost certainly face scrutiny from regulators in various countries looking at potential impacts on competition and market dynamics. Getting the green light across different jurisdictions can be a complex and time-consuming process.
Finally, on the chip front, Intel's stock dipped a bit after their CEO outlined their future plans. Maybe investors were looking for more concrete details on what innovative new chips they're cooking up.
That's a likely interpretation. While a high-level strategic vision is important, investors in the fast-paced semiconductor industry often want to see specifics about future product roadmaps and technological advancements. A lack of detailed information about upcoming innovations might create some, short-term uncertainty in the market's perception of the company's growth prospects.
Okay, let's shift gears again and talk about Tesla. It sounds like they had a rough previous quarter. Horrific was one word used, but their stock is bouncing back a bit. However, sales in some European countries like France and Denmark were down, and we're all waiting to see those auto delivery numbers. It feels like they're facing pressure from a few different angles.
Absolutely. In Europe, increased competition from other EV makers, including significant growth from Chinese companies like BYD, seems to be a major factor. BYD's success in China really underscores the global competitive landscape in EVs.
Right.
Plus, Tesla is reportedly undergoing a changeover in their Model Y production, which would naturally impact their delivery numbers in the short term.
And then there's the ongoing discussion about whether Elon Musk's political leanings are affecting people's buying decisions. It's tough to say how much of an impact that has compared to just regular market forces and product cycles.
It's very difficult to quantify the impact of political views on consumer choices. While it's certainly a topic of conversation, traditional business drivers like the attractiveness of the vehicles, their pricing, the available technology, and the overall competitive environment are always going to be significant factors in the automotive market.
Sure.
When Wells Fargo suggests Tesla needs magic, they're likely referring to a need for a combination of strong product innovation and effective market strategy to overcome these various pressures.
We also can't forget that the $7,500 U.S. EV tax credit might be going away at some point. That could definitely be influencing when people decide to buy an EV, maybe pushing them to buy now while they can still get the credit. We saw Ford and Honda had some jumps in their EV sales.
That's a very logical conclusion. The potential expiration of the tax credit creates a strong incentive for consumers to accelerate their EV purchases. The reported sales increases for Ford and Honda could well reflect this pull-forward effect in demand. Tesla, as a major player, would likely also be seeing some of this.
Tesla has been in China for a while now, but it sounds like their market share is getting squeezed by all the new competition and how quickly the technology is evolving in the Chinese EV market.
China's EV market is incredibly dynamic and fast-paced. While Tesla was an early leader, The rise of numerous domestic manufacturers offering compelling and technologically advanced vehicles has significantly increased competition. Chinese consumers are often early adopters of new tech, and Tesla needs to continuously innovate to maintain its position in that market.
And there was a sobering note about a fatal accident involving a Xiaomi EV, which brings up broader questions about who's liable when autonomous driving features are involved. That feels like a legal minefield waiting to happen.
It absolutely is. As vehicles become more autonomous, the legal framework for determining liability in the event of an accident is still evolving. Figuring out whether the responsibility lies with the driver, the software developer, or the vehicle manufacturer is a complex challenge that regulators and the legal system will need to grapple with as these technologies become more prevalent.
It also sounds like one of the challenges for Tesla in China might be that they're perceived as not launching new models as quickly as some of their local competitors. In a market that moves that fast, you have to keep things fresh.
That's a crucial point. In a rapidly evolving market like China, a consistent cadence of new product introductions is vital for staying ahead. If consumers perceive a company as being slow to innovate and bring new offerings to market, they may be more likely to consider brands that are perceived as being more cutting edge.
Let's circle back to OpenAI for a moment and that massive $40 billion funding. It sounds like SoftBank might be playing a key role, potentially even becoming their biggest financial backer, which would be a shift from Microsoft's position.
Reports suggest that SoftBank is orchestrating this significant investment, possibly involving a consortium of other investors. If finalized, SoftBank's financial stake in OpenAI could indeed surpass Microsoft's, giving them considerable influence over the company's future direction and strategy.
And it sounds like part of SoftBank's involvement might be to help OpenAI diversify where they get their data center resources so they're not so reliant on just Microsoft. That makes sense from a business continuity standpoint.
Exactly. Over-reliance on a single provider for critical infrastructure like data centers can create vulnerabilities. Diversifying those dependencies is a prudent risk management strategy for a company experiencing such rapid growth and demand.
Despite all this massive investment in revenue growth, it's still projected that OpenAI won't be cash flow positive until, the end of the decade? That's a long time to be operating at a loss.
It highlights the immense capital investment required in advanced AI research, development, and the necessary computing infrastructure. Even with substantial revenue generation, the scale of these ongoing investments means that achieving sustained profitability can take a considerable amount of time in this industry.
All right, let's touch on some potential trade drama brewing between the U.S. and the EU. It sounds like the EU is ready to hit back if the U.S. imposes new tariffs. We even heard Mercedes might reconsider selling some of their lower-end cars in the U.S. because of it. That sounds pretty serious.
It is a strong indication of the potential impact of new tariffs. The EU's readiness to retaliate suggests a hardening of positions on both sides. For a major automaker like Mercedes to consider adjusting its product offerings in a key market like the U.S. due to tariff concerns underscores the real economic consequences of such trade measures.
What's interesting is that the EU might target digital services taxes and intellectual property in their retaliation areas that U.S. tech companies are already pretty sensitive about. It feels like they're aiming right at the tech giants.
That's a very insightful observation. By focusing on digital services taxes and intellectual property, the EU could be strategically targeting sectors where the U.S. has a significant economic interest and where there are already existing points of contention. This could definitely escalate trade tensions in the technology space.
It feels like we could be heading down a path of tit-for-tat tariffs, and historically, nobody really comes out a winner in those scenarios, right?
The risk of an escalating cycle of retaliatory tariffs is a serious concern. Such trade disputes can disrupt global supply chains, increase costs for businesses and consumers, and create a climate of uncertainty that hinders economic growth.
One expert mentioned a potential sea change in the purpose of tariffs, maybe shifting from protecting domestic manufacturing to protecting the profits of big tech companies. That's a pretty radical idea.
It is a significant shift in perspective. Traditionally, tariffs have been primarily viewed as tools to protect domestic industries from foreign competition. The notion that they might now be used, even indirectly, to safeguard the profitability of large technology companies represents a notable evolution in trade policy thinking and could have significant implications for global commerce.
And how do you even effectively put tariffs on things like data flows and digital services? It's not like taxing a widget coming across a border.
That's the fundamental challenge. Digital services and data flows are inherently intangible and cross borders seamlessly. Imposing tariffs on these areas could involve complex mechanisms like taxes on digital transactions, levies on access to cloud services, or restrictions on data transfers. It's a very different landscape compared to traditional tariffs on physical goods.
Could all this back and forth actually end up being a good thing for the European tech sector in the long run? Maybe it'll give them more incentive to build up their own competitive alternatives.
It's a plausible scenario. Increased trade tensions and the potential for tariffs could indeed incentivize European companies to invest more in developing their own technological capabilities and reduce their reliance on U.S.-based providers.
Yeah.
This could lead to a more balanced and competitive global tech landscape over time.
They even brought up the intersection of technology and national security, particularly with software used in defense systems. Suddenly, where that software comes from and how reliable those providers are becomes a much bigger question.
Absolutely. In an era where software underpins critical infrastructure, including defense systems like drones, the reliability and trustworthiness of technology providers are paramount national security considerations. Geopolitical tensions and trade disputes can raise legitimate concerns about potential vulnerabilities or disruptions, prompting nations to reassess their technology sourcing and security protocols.
Okay, our last major topic. Rivian is apparently spinning off a whole new company focused on micromobility, basically smaller EVs for short trips. They've got some initial funding from Rivian and Eclipse. What's the thinking behind this move?
The rationale appears to be to tap into the growing demand for more sustainable and efficient transportation solutions for shorter distances. Rivian likely sees a significant market opportunity in smaller, lower-cost electric vehicles that address urban commuting and local errands, recognizing that their larger trucks and SUVs aren't always the ideal solution for these needs.
Right.
Spinning off a dedicated company allows them to focus specifically on this segment.
It's interesting that Rivian already has a U.S. manufacturing presence, which lines up with the government's push for more domestic manufacturing. That could give them a real leg up.
It certainly could. Having established manufacturing capabilities within the U.S. provides a strategic advantage, particularly in the current environment, where there's a political emphasis on domestic production and potential risks associated with relying solely on overseas manufacturing, including the uncertainty around tariffs.
They even mention the uncertainty of the global business environment, including tariffs. It sounds like that's a factor in pretty much every major business decision right now.
The prevailing uncertainty surrounding global trade policies is undoubtedly a significant consideration for businesses across various sectors. Companies like Rivian are likely factoring these potential headwinds into their long-term strategic planning and market entry strategies for this new micromobility venture.
It sounds like they think the current options in the micromobility space aren't really cutting it. They believe they can bring something better to the table.
That seems to be the underlying belief. They likely see gaps in the current micromobility offerings in terms of design, technology integration, user experience, or overall reliability, and they're aiming to introduce more compelling and well-engineered vehicles into that market segment.
Finally, just a quick note at the end here. Elon Musk seems to be getting even more involved in politics, putting significant money into influencing elections, like that recent Wisconsin Supreme Court race.
Yes, Elon Musk's increasing engagement in the political sphere and his financial contributions to various political races are becoming more noticeable. His involvement in the Wisconsin Supreme Court election is one example of his willingness to use his resources to potentially impact political outcomes.
Well, this has been a truly deep dive into a whole range of fascinating tech and economic stories. From AI shakeups to the evolving EV landscape and the complexities of global trade, it feels like we've covered a lot of ground. Thanks so much for lending your expertise to help us unpack all of this.
My pleasure. It's a constantly shifting landscape, and hopefully this conversation has provided you with some valuable insights into these key developments and their potential implications.
Thanks for tuning in to The Deep Dive. If you found this discussion helpful and thought-provoking, we'd love to hear from you. What were your key takeaways? What are you still pondering? Jump into the conversation online wherever you get your podcasts. And if you want to stay on top of all the twists and turns in the tech world with our future deep dives, make sure to subscribe. Until next time.